Hello there, and welcome to the look ahead for the week beginning 27th of May with me, Fiona Cincotta, Senior Market Analyst at City Index. So as always, we'll just start by asking you to read through the risk warning. If you could just take a few moments, I'm going to put myself on mute whilst you just take your time to go through. Okay, so let's crack on then. We'll start, as we always do, by taking a look here at the economic calendar on the City Index website. I've filtered it for the week ahead and also for high impacting events, so we can see what are going to be the main, or what we expect to be the main drivers next week. What we do sometimes is start by working our way through the week, but actually what I'm going to do this week, because I think the main focus is going to be US core PCE. So that's actually not until Friday, but that's going to be the main driver, I think, or the main focus as far as the markets are concerned. We do obviously have lots of other things to be talking about as well, but let's just start with the US core PCE and inflation, because if we think about what's been happening this week, I mean, let's just have a look here. We've got the US dollar. We've seen the US dollar push higher. We've seen gold come lower. We've seen US equities sort of come off despite those impressive Nvidia results, and that's because there is this massive focus on whether the Federal Reserve will be able to cut interest rates later in the year, and whether they'll be able to cut them as soon as September, as the market has been hoping. So we had that cooler than expected inflation data, which saw the market really ramp up rate cut bets for the September meeting. Since then, though, we've had lots of Federal Reserve speakers coming out saying that the interest rates will need to stay higher for longer because of sticky inflation. We've also had the minutes to the FOMC meeting, which were much more hawkish than expected. And then we've also had that really strong PMI data from the US yesterday. So, we've been seeing these concerns that actually inflation is still looking a bit sticky in the US, and those concerns are going to be rolling, I think, into next week, which is why the core PCE is going to be a massive focus. Now, if we just think back to core PCE data for March, that rose firmly. We saw 0.3%. Actually, let me just pick it up here. I've got it for you here. Just bear with me. Here we go. So we saw core PCE rise 0.3% month on month in March. It also rose 2.8% year on year. So, this data reinforced concerns of persistent inflation. We saw consumer spending remain high at 0.5%. That was the largest gain this year. So there is nothing that we've seen in this data so far that suggested that the Federal Reserve need to rush with cutting interest rates. And, if we see this continue to pull over into the April data, if we continue to see sort of, solid inflation figures, then again, there's going to be no real reason for the Federal Reserve to need to start cutting interest rates. And that is going to be reflected in the market. So, as I said, this is the US dollar index that we're looking at here. We've seen this strong rally across the week. I mean, it's down just slightly today, but it's risen straight for the past 5-6 sessions after rounding off the 100 SMI. We've seen this charge higher, struggling there at the 105 level. So that level is pretty key. 105 was the February high. It's also the high that we saw in the beginning of April, end of March. So buyers are going to be looking for a move above the 105 level, which is going to be needed in order to extend gains towards 105.50 and then onwards towards 106 50. But that we're going to need to see stronger than expected inflation data in order to really drive that. But also, not only have we got that inflation data, but that's on Friday. During the week, we've also got plenty of Fed speakers. So obviously keep in mind that Monday is Memorial Day, so the US is closed for the public holiday, but the equity markets are closed. The dollar will still be trading, FX markets still trade, but but we do have plenty of Fed speakers on the Tuesday, Wednesday, who again, the market's going to be watching these commentaries quite closely, as we have this week, for really any clues as to whether the Fed will be able to cut rates in that September period. The market's currently pricing in just a 50-50 possibility now of the Fed cutting rates in September, which is down quite considerably from where it was, just a few weeks ago after that cooler inflation data. So just as far as levels to watch on the downside, if we do get sort of signs of cooling inflation, watch this level here, 104.35. That's the 200 SMA. And also come down here to the 104 level. That was the May low. So they're the levels to be watching on the downside. Now, whilst we're looking at the US dollar, I think it's a good chance to have a look at what's going on in gold, because we've seen that really quite aggressive move lower in gold on the back of these fears that the Federal Reserve could start could keep interest rates high for longer. And we even had in those FOMC minutes several policymakers, or a couple of policymakers, suggest that they could even start raising interest rates again. So concerns about rates really hurt non-yielding gold, obviously supporting that US dollar, which means that gold, which is denominated in US dollars, came under pressure as well. Looking into next week, we get that ongoing sort of hawkish commentary from Federal Reserve speakers and that inflation, which comes in hotter than expected. Then that could obviously see gold extend the sell-off further. Under those conditions, I'll be looking here, this is the first level it's got to come out of, to come below the 2,325. That's the level which found support at today. Below there, I'll be looking at around the 2,300 level before bringing 2277, which was the May low, into focus. If we do find that, for example, the inflation comes in cooler than expected, then obviously we could see a strong rebound in gold. This is proving here to be around a key level is around the 23.55. This is where we've got this zone of the falling trend line resistance and the rising trend line resistance. So that could be quite a challenge for gold prices to get above, but above there, then obviously 2,400 comes back into focus. And just finally, the other one that I want to have a look at whilst we're on with the US dollar is the NASDAQ, because obviously it's been a really interesting week for the NASDAQ. We've had those data, the results in from Nvidia, which were really keenly awaited, and yet despite that sort of surge in Nvidia and the AI sort of trade, actually the NASDAQ wasn't able to maintain that record high of just below 19,000 and has fallen off. And that's as those concerns over high interest rates for longer have just really pulled on market sentiment. It's trading in this rising channel, but look, we are testing at the lower levels of this rising channel here. As far as strong support is concerned, watching out for the 18,466. That was the March high. Got a break below there, then I'd be watching around this level, the 18,000, which is the 50 SMA, prior to around 17,800, which was the March low. So they're levels to be watching as far as the NASDAQ is concerned. Meanwhile, if we have a look, also just worth pointing out there, the rising, that long upper wick on that candle up to that all-time high suggests that there was actually wasn't that much demand at the higher levels. So that again is, it's a little bit of a bearish signal. So they're the levels to be watching on the NASDAQ. So let's just continue working our way down now, see what else we've got going on. I suppose, you know, we've got this Governor Ueda speech. Always interesting when we're thinking about the US dollar, the Federal Reserve, and interest rates, to sort of keep that or to at least do some comparisons to, or some differences to the Japanese yen. Now, we've got this speech from Governor Ueda. We've also got, actually, just whilst we're on Japan, you've got the Tokyo consumer price inflation later in the week. That's on the Friday. Just worth keeping in mind, although it's just Tokyo, that tends to be a lead indicator for what to expect for the Japanese CPI data. And look, you know, below that 2% level last month. So weak inflation is obviously not going to be conducive of the Bank of Japan looking to raise interest rates further. In fact, it will raise questions over their ability to be able to raise interest rates further. And I think we're seeing that here. You know, we're seeing this idea being played out and reflected in the grind higher of this pair of, you know, expectations that the Fed's going to keep rates high for longer, whilst the Bank of Japan may struggle to move on rates again anytime soon. Now, this is this trend line which has been in place since the July last year. Fell below this trend line when we had that suspected intervention, looking really to gain back above that trend line. That's going to be sort of key area of resistance. That's at the 157.60 level, and then you've also got the May high at the 158. RSI pointing higher above the 50. You know, momentum is on this trade side right now. As far as support is concerned, really first strong level of support down there at 155 psychological level. Got medium minor support here at the 153.50. That was last week's low before the 152 level, which was the previous March high. So they're the levels to be watching as far as the yen is concerned. So what else we got going on? We've got Australia, some focus on Australia with retail sales, and also we've got monthly consumer price expectations. So this consumer price index, so that's CPI, the monthly CPI, as well as retail sales. Now this is going to be really interesting to the data coming out of Japan, Australia, because there is this sense that, you know, well, retail sales are directly correlated to inflation. Inflation expectation, inflation in Australia is proving to be sticky. You know, we're still looking at 3.4%, only down very modestly from 3.5% in March. Meanwhile, retail sales are expected to grow 0.3%. So again, there isn't too much reason right now for the RBA to be thinking about cutting interest rates. It does look like rates would need to stay high for longer. And at the moment, expectations of the first rate, as announced by the RBI in their finance report, that the first cut is really expected not until November. So, you know, that is potentially offering some support to the Aussie dollar. Have seen it really run up higher, you know, impressive rally across the first half of the last half of April, the first half of May, where it rose up to that high of 67. Now we've seen some weakness. Again, this is sort of to do with that dollar strength that we've been seeing on that dollar chart. If we just remember that we looked at the start of the this chat. So, you know, just testing a level here around the 0.66. So, you know, if we're finding that retail sales come in stronger than expected, if we're finding that sticky inflation is a case for Australia, that's going to see the market potentially push back RBA rate cuts further. And we could actually see the AUD, USD, the Aussie push higher from this support here at the 0.66. Obviously, again, this does depend on what's going on the US dollar, because if there are concerns over dollar, the Fed keeping rates higher for longer as well, so boosting dollar strength, then we could find, you know, quite difficult for the Aussie to make too much more ground. But let's just keep in focus at the moment. The market is pricing in a rate cut from the Fed prior to a rate cut from the Aussie, so that should help support the price. Obviously, if we get weak data from Australia and cooling inflation, sellers are going to be looking to take out that 0.66 level. That's going to expose the 100 SMA down there at 65.60, and the key level I would say is around the 200 SMA, which is at 65.25, which is also the low that we saw in December and mid-January, or in January. So that's quite a key level to be watching as well. On the upside, strength 66.50, that's a level which has sort of, you know, seems to have offered some level of resistance on a couple of occasions over the last few months, above there 67.15. That is the May high that we're watching. Okay, so moving on, got German inflation data coming in. So if we just take a quick look here at the DAX, just bear with me. So we've had some data in actually from Germany today as well. So this is going to be inflation data that we'll be looking at next week. What's expected? Do we know yet? Let's have a look. I expected maybe, so consumer price index, yeah. So inflation cools to 2.2% in April. There is potential signs of a slight tick higher. We have seen, I mean, if we just think about what's going on in Germany's economy, we have seen signs of, you know, a recovery in the first quarter of this year and heading into the second quarter. So today we had GDP data from Germany, which confirms a 0.2% quarter-on-quarter growth. We've also had the PMI data, which came in yesterday, and again was stronger than expected for Germany, both in the manufacturing and in the services sector. We're not quite back at growth for manufacturing in Germany. That's still some way to go, because there was quite a manufacturing recession there, but the contraction has slowed, which is encouraging. Yeah, the signs of a recovery in Germany is helping to support, or has helped to support, the German index. Obviously, that's gone hand in hand with expectations that the ECB will actually start cutting interest rates in the June meeting, which has helped stocks. But actually, I mean, just have a look. We have again seen this come off from the all-time high that was reached at the end of last week, dropping below here, which is a pretty key level. We're testing it, I would say, at the moment at 18,635. That was the April 1st high. That was the previous all-time high that was reached in April. So if we do get a break below that, I think that's going to be fairly significant. Obviously, this, I think we're seeing this weakness in equities just because of this global sentiment being hurt by the prospects of higher rates for longer in the US. Also, and I'll come to this shortly, we've had the wage growth data from the Eurozone, which actually picked up and I think what could be a fairly worrying signal for the ECB. Wage growth in Germany was 6.2% in the first quarter. So I don't think this is going to be, this data is not going to be enough to knock the ECB off its first rate cut in June, but it may make further rate cuts in the year rather challenging. So that's what to be watching on the DAX. I think we'll just naturally come to the euro now, because we've been talking about the DAX. So we've also got Eurozone inflation data next week. That comes in on Friday. Friday is going to be a busy, busy day. So yeah, expectations are for a slight tick higher. From 2.4% to 2.5%. Again, you know, the figure seems to be pretty much on track for meeting, for the ECB to be cutting interest rates. But as I said, you know, there are concerns about these wage growth in the Eurozone. This is the negotiated wage growth data that came in yesterday, and it shows that it was stronger than expected. It came in at 4.7%. in the Eurozone. Now that was stronger than expected. It was also up from the 4.5% in the previous month. And we know that the ECB are a little bit nervous about wage growth. They had previously, prior to these readings, sort of raised concerns over wage growth being a hurdle for cutting interest rates. Obviously, higher wages does feed into inflationary pressures. So that, as I said, I don't think it's likely to knock the ECB off from cutting rates in June, especially if we've got inflation down at the 2.5% level. It's, you know, it doesn't appear to be too much of a concern, inflation right now. We've had Christine Lagarde say that she believes that the inflation battle is under control, which again is an encouraging sign. Also, it highlights the differential, though, of what we've got going on between the US and the euro. So if we think back to that DXY chart where we saw the dollar increasing across the week, we've seen the euro heading lower. Obviously, it's found a little bit of support today around that 108 level, and we're just seeing a slight recovery. But I think, you know, overall concerns of the Fed keeping rates higher for longer and the ECB looking to cut rates will, you know, keep pressure on this pair, potentially keep it below that 109 level. But as I said, we have seen this recovery. We are seeing this recovery in the Eurozone, which will potentially limit the downside in euro US dollar. We get a break below that 108 level. So if we're looking at sort of cooler than expected inflation data next week from Germany and also from the Eurozone, then I would be watching this level here, 107.85. That's the 200 SMA. If we get a break below there, then I think there is a potential for the 107.25 level. So that was the December low and also the low here and here to come into play ahead of 107, which was the February low. If we actually get hotter than expected inflation, then hotter than expected inflation combined with signs of recovery and that stronger than expected wage growth, then we could, on those circumstances, and if we see cooling US inflation data under those circumstances, then I would be looking out for a rise towards that 109 level and potentially up and above it to make fresh higher highs for the May period. But as I said, there are quite a lot of ifs and buts we'd need to be seeing in order for that level to be broken. Okay, so let's just have a quick look to see what else we have going on this week that we haven't really covered off. So yeah, sorry, we've also got the budget that was in Australia. So we've done German. Okay, Bank of England Governor Andrew Bailey, that will be interesting. Basically, we had some retail sales data out today, weaker than expected, much weaker than expected, showing that UK households really are struggling now that inflation is easing, well, even though inflation is easing, but as interest rates remain at the 16-year highs. Now, we did have inflation cool to its lowest level this week of 2.3%, lowest level since summer 2021. Good news, but it was slightly hotter than expected. Expectations was 2.1%. So the market did actually, and service sector inflation was sticky at 5.9%. Core inflation was also stickier than expected. So basically, although it's cooled quite a lot, there are still some signs of concern or some areas of concern for the Bank of England in the data, which is why we've seen the pound, you know, remain above, sort of supported above the 127 levels, even though we've seen that strength in the US dollar, because there are some concerns that the Bank of England will not be able to cut interest rates as soon as the market had been hoping. So the June rate cut expectations have been pushed back now to August. As far as this chart is concerned, though, I would just be watching out. Look at those long upper wicks on these candles. That suggests that the demand at these higher levels was weak. And we're just seeing the price steady around this 127 level. So, you know, if we hear some dovish commentary from Bank of England Governor Andrew Bailey, then that could help to push the pair down to that 126.30 level, which is that static resistance, also the 100 SMA. Especially, I think it will be really interesting if we hear a slightly more dovish Andrew Bailey, but because he has been relatively dovish in recent speeches, sort of pointing towards rate cuts and saying that he's comfortable that the central bank is on track to cut rates. And especially if that's contrasted with more hawkish sounding speeches from Federal Reserve officials, then that could put some pressure on pound US dollar. Below this level here, 126.30, watch out for the 200 SMA at 125.50. If we find that actually Andrew Bailey sounds actually a little bit more cautious and more hawkish than he has done in previous speeches, that could help lift the pound. But let's not forget here that we've also got the announcement of a general election in the UK, which could mean that demand for the pound remains weak, really, because of that political uncertainty that we have over the next 6 weeks whilst the election campaigns are played out. But anyway, if we do see strength in the pound, watch out, levels on the upside, 127.60. Strength on the pound, this could also be weakness in the US dollar, and then above that, look at 128. But I think for the time being, it does look like the high might be in for the moment there. Just what else are we going to look at here? I'm just conscious of time. We've done, so we've got German retail sales that will be interesting as well. The one thing that I just want to have a quick look at before we have, there is China data as well, isn't there? There we go. We've got manufacturing figures in from China and non-manufacturing PMI data. So this is going to be very much in focus, and a sort of hope and optimism that the recovery in China is sort of finding its feet. One thing to watch as far as manufacturing data is concerned is the oil prices. Now, oil, look at this, it's down over 4.5% this week. We've had a real sharp drop off. Look, it's taken out this level here actually. So we've seen it fall below this rising trend line. We've seen it fall below here, this level here, the weekly low. So it's creating fresh lower lows, trading at levels that we haven't seen since, let's just have a look. When was the last time we saw this level? Around mid-February. So, and this is basically, we've seen concerns over, the prospect of high interest rates for longer could potentially weaken growth in the US, and that would be bad news for the oil demand outlook. If we get some strong China data, particularly manufacturing data, that we could find that sort of, oil looks to move back above that $77 the barrel. But if we get, continued hawkish comments from Fed speakers, as well as the, sticky inflation, then that could lead oil to look lower towards the 75 level, a level that was quite important in mid-February, and below that 75 round number comes into play. Just on the upside, as I said, 77, that's Q1 to watch on the upside, and also the 78.80 level, which is the 100 SMA. It's also the rising trend line support. But I think this chart still looks bearish. We're below the 200 SMA. We've got below 50 on the RSI, and we've taken out the lower low. So, there is a potential for this to actually continue falling lower. So that is all we've got time for today. I hope you've enjoyed it, and I look forward to seeing you again next week.